Welcome, everyone. My name is Eva Kubu, and I'm the Associate Dean for Graduate Student Professional Development and the Director of the GradFUTURES Initiative at the Graduate School. Thank you for joining us for the Engage 2020 conference, the first of its kind conference on innovation and entrepreneurship at Princeton. We're delighted you could be with us today. As Vice Dean Rod Priestley mentioned this morning, the conference aims to bring together all members of the innovation ecosystem: faculty, staff, students, alumni, government, industry, and community partners, so that together we can inspire connections and collaborations that will bring brilliant ideas to life and make a positive impact on society. Just a few housekeeping details. To optimize your viewing, select full screen or theater mode. At the end of the session, our speakers will take questions. Please kindly submit those via the poll module on the Pathable website. I'd like to begin by saying that graduate students are at the heart of innovation and entrepreneurship at Princeton. Each and every day, they're at the forefront of creating new knowledge and accelerating discovery. The newly launched GradFUTURES Professional Development Initiative at Princeton prepares graduate students with the professional skills and competencies they need for success across all fields of endeavor, and provides on-ramps to a diverse array of professional pathways, including entrepreneurship. We're so grateful for the outpouring of support we receive from our alumni community. Princeton alumni serve as role models, advocates, mentors, and we're so grateful to our alumni speakers this afternoon: Jim Cohen from the great class of 1986 and Mark Poag of the great class of 1993, who have been doing just that and more for many, many years. To say that Jim and Mark are dedicated alumni is an understatement. Their service to the university spans 2 decades of serving in multiple and ongoing volunteer alumni leadership roles. Jim and Mark's impact on the Princeton entrepreneurship ecosystem has been truly extraordinary. Jim and Mark are managing directors of Fitz Gate Ventures, a venture capital fund solely dedicated to the Princeton community. Over the years, Fitz Gate Ventures has examined more than 500 companies founded or run by Princeton alumni. Their portfolio includes startups spanning the tech, entertainment, and finance industries, and more. And their firm invests in startups in which a Princetonian is either a founder or a member of the senior management team. And their dedication to the Princeton community does not stop there. 3 years ago, Dean of the Graduate School, Sarah Jane Leslie, and Assistant Dean, Amy Pizolkowski, asked Jim and Mark to help us design a program that would introduce our graduate students to the world of startups. They created such a unique seminar series, sharing their knowledge and expertise and facilitating connections to the broader innovation and entrepreneurship ecosystem. They have inspired so many graduate students over the years to transform their ideas and discoveries into meaningful real-world solutions with significant impact, social, economic, and human. Today, you will get a close-up look at why their venture capital and startups learning cohort has become one of our most popular offerings and serves as a crash course for graduate students interested in understanding the world of VC funding and startups. In an interview a few years ago for the Princeton Alumni magazine, they said their goal was to help generations of Princetonians build, grow, start, and exit companies, so that when people are talking about the top entrepreneurial universities, they'll say Stanford, MIT, and Princeton. Thanks, Jim and Mark. I'd say mission accomplished.
Okay, well, thank you, Eva, for that incredible introduction. I almost feel like we should end the presentation right now before we blow it. And also, I want to thank everybody who's tuned in to this session. Hopefully, we will cover a lot of ground today, and we'll have Q&A at the end. I thought I'd take the first couple of minutes to kick us off with just a little more background on Fitz Gate, so you know where we're coming from. Mark, we can go to the next slide. So Mark and I founded the firm about 5 years ago. We're on our second fund. The thesis around it, as Eva alluded to, is basically backing Princetonians, essentially companies where a founder, senior team member, investor, board member, advisor is a Princeton alum, faculty member, or potentially even a student or graduate student. We've actually evaluated over 1,000 startups, which says a lot about how active Princetonians are as entrepreneurs. We've got about 25 million under management. We typically come in the earliest stage, seed and even pre-seed deals, writing checks to sort of a minimum of 500K and then reserving for follow-on rounds. And as we said, technically we only have to invest a majority of our fund in Princeton-related startups, but so far virtually every single company, and we've invested in 18 so far, has a nexus to Princeton. Next slide. So one of our sort of the secret sauce, and as anyone who's been a founder or invested in startups knows, you have to sort of add more value than just money. And what we bring basically is the Princeton Network to bear to help our founders be successful. They've also been incredibly helpful in helping Mark and I evaluate different opportunities, get deal flow, and then ultimately when we invest, help our founders with introductions to customers, additional sources of funding. We refer to that network as the Friends of Fitz. We have about 250 alumni, faculty, administrators, trustees who are informal advisors to the fund. You can see them all on our website. They've really been invaluable, and the founders we've backed have also found them to be very useful. Mark and I, as Eva said, are very involved in things on campus. We're trying to help cultivate the next generation of entrepreneurs that we can back, whether that's participating in the eLab advisory committee or being mentors to the Princeton Entrepreneurship Council, which coincidentally formed at exactly the same time that we launched Fund One. So I feel like our timing was pretty much perfect. And then we do a lot of outreach to alumni. We've done events all over the country, and from Seattle to New York to Naples, Florida. And the idea there is to basically get the word out that there's a source of funding available and to generate deal flow. Next slide. So here's our portfolio. I encourage you all to go to our website and check it out if you're interested in learning more. Virtually every single vertical is represented here. That wasn't even by design. It sort of happened that way, which again sort of speaks volumes to the breadth of the Princeton network. We've had one exit so far. We had a cybersecurity deal that sold to McAfee about a year ago. We're early stage, so most of these are obviously all of them are still active, and many have raised follow-on rounds at significant premiums from where we invested, which is a fantastic data point. You'll see that a couple of these deals are tech transfer deals. We love those kinds of deals, but mostly what we're backing are early stage companies, as we said earlier, founded by Princetonians. So if you go to our website, you can learn more about all these companies. Next slide. This is just sort of early validation. Very early on, it became clear that this model was going to work. As one example, Princeton alum named Rob Shulkoff, who's run the Yale Quantum Institute for over 2 decades, spun out of Yale a quantum computing startup. And Mark and I were the first institutional money with Fitz Gate to invest. And then very quickly, it became clear they needed a lot more capital. And within 7 months, we helped them get connected to their Series A funding, which was basically $18 million from Sequoia, Canaan, and Tribeca. Over time, in the middle there, is an incredible company with over almost 2 billion views per month. It's already raised. We were in the first round with Graycroft as the lead. Kevin Durant, Andreessen Horowitz followed us. Just an incredible stable of investors have come in now for 3 rounds since we've invested, and we've participated in every round. The last one there, Optical Dynamics, actually Daniel Powell is speaking at this conference. He's, I think, the keynote, and we're super proud of that because that's a tech transfer deal out of Princeton. And we were the first investor in that as well. And they just closed a $4 million follow-on round a few months ago. So they're doing really well, and I encourage you all to follow them and listen to Daniel's speech. But also one of the things that's cool is through the Princeton Network, again, we were able to introduce him to literally the largest company in the world to do his pilot, one of his pilots. Next slide. I'll hand it off to you, Mark.
Great, thanks, Jim. Yeah, and I guess it's important also to note about those prior companies is that although we have a focus on the Princeton entrepreneurial ecosystem, those funds, those big funds that followed us, do not. And so it's a good validation of how great the Princeton entrepreneurs are. Okay, so today we're going to talk about fundraising for early stage startups and in some level of detail. So we like to start with this slide because financing and fundraising for startups really is all about Runway. And by Runway, for those of you on the webcast who are not in our GradFUTURES class, where we talked about different definitions in one of our earlier classes this year. Runway, when we talk about Runway, we're talking about the time a company has before they're going to run out of money. And so when you're financing a startup, when you always want to focus on, do you have enough runway to achieve the milestones that that will allow you to raise more money or to achieve your goals? And so usually those milestones are, are you going to get X number of customers? You can generate some kind of level of revenue. Are you going to become profitable? Are you going to reach some product development milestones? That sort of thing. And usually we try to look for, we want to only finance companies, participate in financings of companies that are going to have at least 18 months of runway, with the idea being it's going to take at least 12 months to achieve those milestones. And you need a little extra time to raise your next round of funding. But in COVID, that time period is actually extended a bit, just because COVID has obviously compressed or expanded sales cycles and time to reach those milestones. And so many VCs, us included, have actually are looking for longer periods of runway than the 18 months we would typically look for. And so there are lots of different sources of funds for a startup. Many companies immediately jump to the bottom when they're VCs, but there are lots of others as well. Some of which are non-dilutive, which means that you don't have to, the startup founder doesn't have to give up ownership of his or her company. And we'll talk about each of these. And then some of which are dilutive. And those are more focused on equity financing. And many of these other, and we'll talk a little bit more about it, but even though angels and VCs and accelerators get the preponderance of attention in fundraising for startup companies, some of these others are really good places to start and may be more appropriate for the company. So just starting with bootstrapping, and by that we mean basically using internal cash flows to run the company or other sources of non-dilutive financing like government funding. So in terms of internal cash flow, it's a good idea to try to bootstrap as long as you can, as long as in so doing you're not going to inhibit the future growth of the company. You don't want to be penny wise and pound foolish and inhibit your future growth by not raising money when you could. But there are lots of examples of companies that have bootstrapped for a pretty long period of time without raising any outside capital until they've built up some size and scope of the company. And then when they do go out and raise capital, they can do so at higher valuations and give up less ownership of the company to investors.
Hey, Mark.
Yeah, go ahead.
Sorry, I was going to say one great example that just came to mind is Wisant, Andrew G. Ant, who's a Princeton alum who founded his company. It's a tutoring company. I think he bootstrapped for, I want to say like 8 years and got the company up to maybe 60, 70 million in revenue. And then he raised a $20 million round from Excel. So that's kind of an extreme. You rarely see companies bootstrap that long, but obviously he was able to create quite a bit of equity value for himself and his co-founders and his employees before, suffering any kind of dilution from outside investors.
Yeah, that's a good example. I was actually going to give that in just a second.
Oh,
but
no.
Yeah. So we're thinking on the same page. Another source of funding is government grants, and we'll talk about that in just a second. And then incubators and accelerators are a really good way for a company at its early stage to build the company and get a lot of assistance from people with experience growing and building startup companies without giving up too much equity. And there, the common examples are Y Combinator or Techstars, but Princeton has an accelerator as well, the Princeton eLab, and many cities wherever you are also have accelerators and incubators that are specific to the city. And then bank loans, that's another option for early stage finance for some companies. It's pretty unusual in high growth companies just because most banks won't lend against a startup company that doesn't have significant cash flow or assets, and most startups don't. All right, so government grants, for those of you who are professors or grad students at Princeton, you probably know a lot more about this than we do. But basically the SBIR program disperses more than $2 billion a year to companies. That money has to be used for basic research. It can't be used for sales and marketing, but for companies that are at a very early stage and have some work to do on development of the technology, it's a really good source of capital because it's non-dilutive, and there are usually not too many strings tied to getting that money from the U.S. government. And again, if you're an employee of the university has lots of resources available to you to help secure these kind of grants, government grants. And if you're not an employee of the university, but you think you might be eligible for these kind of things, we actually have one of our friends at Fitz, which is that program Jim mentioned earlier, who is an expert in securing government grants for startup companies. Okay, I'll turn it back over to Jim.
Okay, so this is really where we come in and where all venture capitalists come in. It's really the equity, part of the equation. And as Mark mentioned, when you're in a high growth mode, venture capital and getting equity investors is really the only way to get the kind of funding you'll need, since banks, again, aren't going to loan against zero assets and particularly zero revenue, which is often when we and other seed investors invest. One of the things, and when you're looking at who the investors are in a company, something you would look at is called the cap table. So that's one of the first things we look at is see, who owns what. And the important thing to realize about equity when you're asked to be, if you're an angel investor or a VC, you need to understand where equity sort of relates in the hierarchy of a balance sheet. It means basically you're at the bottom. So, while that can sound bad because if a company liquidates, you're the last to get any proceeds after banks and senior creditors. The good news is that as an equity owner, there's really unlimited upside. And that's why venture capital exists. So let's turn to the next slide to talk about convertible notes and safes, which basically, as the slide says, convertible note is a debt instrument, but it's really more like equity. This is the most common form of investment often that we see, although we also, I'd say it's 50-50, whether we do a priced equity round when we invest or we invest in a convertible note. One of the reasons why companies love to do convertible notes and why investors like them as well is that it's very quick, it's very easy, they're pretty standardized, and it doesn't cost as much in terms of legal fees to draft up a set of convertible notes. There are some downsides to them. But it's a very quick and easy way to take in relatively small amounts of capital. If you really don't want to raise too much under your convertible notes. We can talk about that a little bit later. But the typical structure for a convertible note is that it has a maturity date that's 12 to 24 months, typically, let's say 18 months. And it's no coincidence that it coincides with that runway Mark was talking about. So there is a maturity date, but you have no intention as a convertible note investor to get repaid. That's not what you want. You want to give the company enough time to basically raise its next round. And then what happens is in the next round, your debt just converts into the preferred stock that is issued at that next round. And the way that a convertible note, if you've been around them at all or seen investment opportunities, people always refer to a cap and a discount. Those are the two primary terms of a convertible note. And what does it mean? A cap is basically a proxy for valuation. Now people will debate it all day long. It's not really a valuation, but basically it is. And so typically, like when we go in as a seed investor, we want to see a cap south of $10 million. And the reason is the company really isn't worth usually anywhere close to that at that point. So a good seed investment, call it a $5 million to $10 million cap on a note. If the company's got some customer traction and some revenue. But to give you an example of how this works and what the discount means is, let's say you have a convertible note that you're investing in, which has the reason why you want a maturity date too, by the way, is to put a little pressure on the company to sort of light the fire that they need to be out there raising this next equity round that you convert into, because they don't want you to hit a maturity date and have to potentially deal with repaying you. But the cap, let's say you set a cap at 10 million, as a seed investor, if we went into a 10 million cap, that'd be high for us. But the goal would be, let's say at the next round, they raise a preferred stock round of, a Series A of at a $20 million valuation. Well, what happens is our note converts at the cap at the $10 million valuation. So we're getting a significant benefit, but we're getting that benefit because we took the risk before the company hit all those milestones over those next 18 months. Now, that doesn't always work out that way. As a venture capital investor, that's what you want to see happen. You want to see the next round, the Series A, be at a significantly higher valuation than your cap, and then you get the benefit of that delta. But sometimes companies hit bumps in the road, particularly in COVID. And so if you invested pre-COVID or some other reason, let's say the company had a 10 million cap and the next round was at 8 million. Well, then that's where the discount comes into play. And so the venture investor or the note holder, angel, whoever is the investor, would then convert at a 20% discount to that 8 million, which would be 6.4. And so there's still a benefit. It's not great because you're sort of going the wrong direction, but at least you're investing at the next round at a discount. So a convertible note's a very clever structure. It works pretty well. And you'll see them very frequently. Next slide.
Glad you did that quick math on the discount. I'm not sure I could have done that in my head.
Yeah, hopefully it worked. So the SAFE is something that was super hot when particularly, even over the last 5 years that we've been investing Fitz Gate funds. Early on it was even more popular, and now almost never see them, or we don't invest in them. As an institutional investor, you don't like SAFEs. SAFEs was a creation of Y Combinator. You've probably all heard of it. It's encouraged by certainly by educational institutions and people that are early in raising funds, because it's even simpler than a convertible note. It's basically neither debt nor equity. There's no maturity date. It doesn't show up on the cap table, and also a convertible note doesn't show up on the cap table because it's not equity, but a convertible note at least shows up on the balance sheet. So as an investor, when you're doing even just your rudimentary due diligence, you'd always ask to see the financial statements and you would see the balance sheet. But you wouldn't know that they had a SAFE, and a SAFE stands for a simple agreement for future equity. And that's really all it is. So all it is you invest on a SAFE. It just says, when we raise this next round, you will convert and it'll have a cap and a discount too, but there's no timeline, there's no maturity date. And so there's really no teeth in it at all. And it is very founder friendly, and plenty of them do get issued. But as an investor, it's not investor friendly at all. And in fact, there's not a really good reason as an investor why you should ever invest in a SAFE, unless you're an angel and it's the path of least resistance and you got no leverage. But there are definitely some pitfalls with it. Okay, next slide, Mark, please. So the holy grail and what we mostly invest in is preferred stock. This often happens at the Series A round, but I'd say the majority of our deals, Mark, are probably what we call priced rounds. All that means is instead of investing via a convertible note, we actually just create the class of preferred stock and issue it when we invest. And it just makes life easier generally, but it does cost a little more and it's a little more complicated because preferred stock has a lot more rights. But if we're coming into a typical seed round where we're a $500 to $1 million check and there are a couple of $1 million more of investors, I think it's important to really button it down. And you don't want to have 3 million issued under a convertible note. And so what is preferred stock? When I talked about the balance sheet, the preferred stock basically is below debt. So in a liquidation of a company, it comes after the bank and other creditors are paid, but it comes above the common holders, which typically is what the founder and the employees hold. And the reason why preferred is important from an institutional investor point of view is upon a liquidation, preferred does have priority. Of course, nobody's thinking about liquidation. The main reason why you do preferred is because it enables you to have other terms and conditions around your investment, and those are really built into the terms of the stock. So things like, governance, whether you have a board seat or you're a board observer or you have information rights to get quarterly financial statements, rights to invest, they call it pro rata rights, right to invest in the next round. You know, that's not always a given. Like if you're in a safe, you might have, you know, Sequoia coming in the next round and you're like, I want to double down, and you're in a safe and they're like, sorry, you don't have pro rata rights. You don't have the opportunity to participate. And so that's another example why you want to have preferred stock. Okay, next slide.
And just to give a little context, I mean, when Jim's right, it is a little more expensive in transactional costs to issue preferred stock versus a convertible note, but we're talking about, you know, in the context of a $2 or $3 million round, $25, $30, $40,000. So not that significant.
Yeah, max. Yeah, and it protects the founders too, because as we alluded to earlier, if you do too much under a convertible note and then your valuation doesn't work out the way you want it to work, short version is the person who gets squeezed there is the founder and the employees. And you, as an investor, you don't want that because you want your founder to be the one who holds the most stock and is properly motivated. So it's very easy when people just keep issuing notes or safes to lose track of how much they've issued. And then, you know, they get in this vicious cycle of like, well, do I have a high enough valuation to basically convert where it makes sense and I don't get squeezed? So issuing preferred stock prevents all that. Okay, so last thing on equity sources is basically, what are the categories of equity sources? So friends and family, you always hear about that. And we love to see it when founders come to us to say, have you raised friends and family? You know, first of all, you love to see it if a founder has the resources, that they put their own money into the startup if possible. Having friends and family in the deal first is great because it's a real, it gives the institutional investor some comfort that this founder is serious, that they're not going to fail fast, even though that's kind of was a glamorized term for a while. Nobody wants you to fail, and you're less likely to just throw in the towel and move on to your next deal if you've got your, Uncle Sam and your dad and your mom or good friends in the deal. So I think it's good to try and make sure that, and you as a founder, that's the easiest source for you to get capital from, obviously, before you have any milestones at all. And so that's a very typical thing to see. The other one that's usually simultaneous or maybe right after friends and family is angel funding. Lots of great ways for angels to invest today that didn't exist 10 years ago. I mean, the most obvious is you've got AngelList, but then you've also got, angel funds around a lot of the big schools, like Princeton Alumni Angels formed a couple years ago. And that's a vehicle for you as alumni to look at early stage deals that are probably a little bit too early for us, but that could be great opportunities. And so typically, as an angel, you wouldn't be setting a price round. You'd be doing, let's say, a convertible note. But sometimes we go in and we lead around with angels. So we've done kind of a combination of those things. So, we'll also get in super early. The other way that you can raise funds, besides from venture capital, which Mark will talk about in a second, is from strategic investors. And sometimes it's really attractive if you're in a certain industry, if an industry leader expresses interest in investing in your company. It often doesn't happen in the pre-seed stage, but sometimes it does, and sometimes it happens in the seed stage. And so it can be very exciting for a founder to take that money. And there's nothing wrong with taking it, but there are a couple of things to be aware of when you do that. The main things that we as an institutional investor look at is make sure that that investor, if they do come in, doesn't have any special proprietary rights or a first right of refusal to, let's say, buy the company when you engage in an M&A transaction. That would be the kiss of death from ever raising venture capital or really any additional money, because as an investor, you don't want there to be someone on the cap table who has a preemptive right to buy the company, because then no one else is going to give it a serious look. And the other thing is, even if they do come in on a so-called heads-up basis with every other investor in terms and conditions, there is something to be sensitive to in terms of if they invest a meaningful amount and they take a board seat or even just a board observer seat, or even if just have information rights, they're going to have access to information that you may not want them to have as a competitor. So there's just a couple of things to think about there, but it can often be good. And the next one, obviously, is what we're involved in, which is venture capital. And I'll turn it over to Mark for the next slide on that.
Okay, thanks, Jim. Right. So venture capital. Venture capital is it gets a lot of attention, but what it really is, it's just another source of capital for startups, and it's very specialized to startup companies, primarily for startup companies that have the capacity and desire to grow really fast, and they need to do that to basically succeed and meet their business plan. And when we say grow really fast, we mean, at least double, if not triple or quadruple their revenue growth every year for the first, 4, 5, 6 years of the company, and grow to a very big size in a short period of time. And venture capitalists typically bring more to the table than money. So they bring money and an ability to not only invest once, but also in subsequent rounds, and continue to provide money. But they also, venture capitalists typically bring connections, which can be useful for sales and business development. They bring guidance because they usually have lots of other portfolio companies they've worked with in the past and can bring to bear some of those, some advice around that. And also brings some validation and imprimatur. So, depending upon the big name of, or whether the venture firm has a good name in the industry that the startup's targeting, that can help lend an imprimatur both for employees, bring on employees, bring on new customers, and raising additional capital in the future. And this guy is named Mark Andreessen. Mark Andreessen has an outsized, has had an outsized impact sort of on the venture capital industry because he's very outspoken about investing, and venture capital investing in particular. Excuse me. And his head actually looks like that. But one thing Mark Andreessen has said, and I think he's right about that, is that venture capital investing is really about finding outliers. It's not finding companies that check all the boxes and that have everything lined up and that look good. It's about finding the companies that have may not check all the boxes. They may have some problems, but they have the opportunity to be huge, to dominate an industry or create a whole new industry that didn't exist in the past. Think about, Facebook or Airbnb or Uber or companies like that have created whole new industries. And in that's related to, we're not going to get into it today, but that's related to sort of how venture capital firms are organized and how they invest their money. That really, they're not looking for a good return. Like they're not looking for, you invest in a public company stock and you're happy if you get a 20% return a year. Venture capital funds want to generate at least a 10 times return on their investment. If you talk to another famous venture capital investor, Peter Thiel, he said he thinks that each investment should be able to return the entire capital of the fund. So if you have a venture capital fund with $100 million and you make a $2 million investment in a particular company, that company alone should be able to generate a $100 million return. Most venture funds are not quite that aggressive and target a 10 times return. But if you think about a 10 times return on an investment, and usually the hold period for venture capital firms in the range of between 5 and 7 years. So that's a very, very high IRR. And so that requires companies that are going to have that ability to grow very, very fast in a short period of time. Jim, anything you want to add on that?
No, I would say just as far as we're concerned, and I think you said it in the previous slide, our sort of criteria is more around the 10x. We have nothing against creating unicorns, but that's why we specifically look to get in early at lower valuations, specifically and generally in companies that are capital efficient, so that we can generate that 10x return, even if you have an exit that is well below $1 billion. And so I think that gives us a lot more opportunity in terms of deals that we can invest in. I think it's more typical of the West Coast firms to have that attitude about it must return the whole value of the fund. And if it's not got unicorn potential, typically they won't invest.
Right. Yep. Good point. Okay. So what has been going on with venture capital in the time of COVID? So like most investors, anytime there's a period of uncertainty, that leads to reduced investment. If there's sort of macro uncertainty, and COVID, of course, has been a period of macro uncertainty. So initially in the March sort of April timeframe, most venture capitalists, including we at Fitz Gate, spent the first few weeks trying to figure out, do our portfolio companies qualify for a PPP loan? What are the terms of the loan? And should they apply for it? And many of our companies did. And then we quickly pivoted, as many venture capitalists did, into doing triage on our companies. Assuming that their sales are going to be hit significantly year over year because of shutting down businesses and shutting down much of the economy, is are they going to have sufficient runway to meet the milestones that we've set for them, and which are going to need follow-on capital, and which are going to just need to cut their costs and expenses to extend that runway. And most portfolio CEOs of both our portfolios, but also generally in the startup industry, did that very thing. They renegotiated leases, they cut salaries of executives, they cut expenses and tried to extend that runway. And then for those companies that were on track to achieve their milestones, but for the pandemic, then we and many other firms did follow-on rounds to extend that runway to make sure that they had adequate time to meet those milestones. And then sort of towards the end of the summer, we found that companies were startup companies were starting to come out of the woodwork again and seek funding. And so during this sort of period of COVID between March and let's say Labor Day, seed stage, at least at the seed stage, funding was down 57% year over year of new investments in new companies. But we found that starting probably around Labor Day, that there have been a lot more companies coming out and raising money, and we and many other venture funds have been willing to make investments over Zoom without, or other video technology, without in-person meetings at all. That's usually been sort of a sacrosanct requirement of venture capitalists, that they meet and break bread with founders before they invest. But many, and including Fitz Gate, have gotten over that hurdle and started making investments over video.
Hey, Mark, just a heads up, we got, I think, a couple minutes till the Q&A.
Okay, great. Well, I'll go quickly through this. Basically, you can see on the y-axis is capital required to reach cash flow positive, and novelty on the bottom. And so basically all this saying is that most companies that are founded are in that low novelty, low capital requirement. And those could be great businesses, but they're not really appropriate for venture capital. What's really venture capital is focused on is companies that have high novelty and low capital required to reach cash flow positive, that are capital efficient, as Jim said.
Okay, so I'm just gonna breeze through this. We're gonna make this deck available to you all. So I'm not exactly sure how, but also you can go to our website and find our email addresses, and if you can't get it directly from this site. But if you're an entrepreneur and you're looking for funding, these are the first things we always ask for, at least, is, well, first of all, know an elevator pitch. I mean, literally, it sounds cheesy, but, be able to say in 2 minutes what your company does. If it takes longer than that, then, you got issues. And have a pitch deck ready, have a financial model ready. Even though Brad Feld, he's a famous VC investor, he's famously quoted as saying, I've looked at 5 million financial models. None were ever correct. You still have to directionally sort of show that this can scale appropriately, because a lot of times that's really what we're looking at is your 5-year revenue growth sufficient to really justify a VC investment? Because maybe you don't need it in terms of those other quadrants Mark was pointing to. Maybe you just could grow your company and get very wealthy raising bank debt. And then the cap table, and as I said earlier, that just shows you who are the equity owners of the company. The next slide, Mark, please. I would say this is a high-level framework of what you want to address when you're pitching a company, and these are the things we as investors look at. The team, especially early where there's very little data, that's the most important thing. What's your background? You don't have to be a prior successful founder, but you have to have sort of a compelling vision and have a good track record and other things that you've done. Then, what's the problem? What's the solution? We often see entrepreneurs starting companies where it's like, yeah, you got a solution, but I don't know what the problem is. So make sure it's a real problem. Best way to make sure that's happening is if you're a missionary founder, meaning you were in that industry or you experienced that problem yourself. So that way, this is a real problem, it's a pain point, and I'm going to solve it. Addressable market. How big is the market? It's got to be big enough to scale to grow 2 to 3x per year. So, think about that in terms of your sales. Then the other thing we focus on is the go-to-market. How are you actually going to sell this? Are you going to have to go, are you just going to advertise on Facebook? Well, then you got to raise, $25 million. How are you really going to get customers? How long is the sales cycle? What's your revenue model? How are you going to make money? Competition's
Well,
relevant.
I'm sorry, Jim, let me interrupt there. So I would say that is the number one area that we see lacking in business plans or in pitch decks is the go-to-market. A lot of times, especially technologists, create a great technology and they just assume, they build it, customers will come, but that's not the way it works. You've got to have a great product and a great go-to-market strategy.
Yeah, we have a couple of examples where the founder spent 2 years working on a technology and a solution and then brought it to a customer. The customer was like, nah, I don't need that. I don't want that. I like the way I'm doing it. So the next thing, competition. You don't have to be the first mover. Being first mover can be good, can be bad. Sometimes being the first follower is actually a lot better. Just think of like Coke, Pepsi, Burger King, McDonald's, Intellectual property, good to have some if you got some, but it's definitely not a requirement, but you should try and patent things that are proprietary. Again, fundraising history is relevant because if you've, let's say, as a seed company, already raised $10 million and burned through it, you're coming to us asking for more money and you don't have revenue yet, forget it. Make sure that the amount of money you've raised and burned through is sort of commensurate with what your revenue is. Because if you're not scaling and you're not investing your money wisely, then you're not capital efficient and no institutional money is really going to want to get involved. The financial forecast, again, is really just more directionally relevant for investors to see what your timeline looks like and what your milestones should be for your next rounds of raising money. And then, of course, exit opportunities. If you're not, I once got something from a founder who said, I never really gave this any thought. Well, don't ask for outside money if you don't know how your investors ultimately, we're long-term investors. We'll hold for 5 to 10 years if we have to, but we do ultimately need to return our money to our investors. Okay, the next slide, Mark, and I'll just point this. I think this is a good checklist for those of you that are founders or investors, okay? Because as an investor, you should make sure you get all of these questions answered. Real basic stuff. Company should be a C Corp. How long have the founders known each other? Mark and I started Fitz Gate. We knew each other for 25 years, and we were very much a startup. And it's really important to make sure that they are simpatico with each other because a lot of times that can crater a company. How big is the market? We talked about a lot of this. Lifetime value to CAC, you hear about that a lot. Really, what's your customer acquisition cost? And then ultimately, how much will your customer buy over the lifetime of them being a customer? And if your company doesn't know how to calculate that, that's potentially a problem. Generally you want to speak to some customers. If they don't have customers, obviously it's not relevant, but if they have any, you definitely want to speak to them. Another big metric we follow and everyone follows is MRR. It's nothing fancy. It's just monthly recurring revenue. That's a metric we and other investors look at to just sort of spot the growth as opposed to just saying, what'd you do last year? You want to, because it changes in real time every 4 weeks. Next slide, Mark. Sorry, I'm going super fast, but I think this is self-explanatory and everybody can look at it directly afterwards. And we're late for the Q&A, but we talked about a lot of this already. The main thing we ask is if you're raising as a founder, you come to us or any investor and say, I'm raising $2 million. We want to know, what are you going to use the $2 million for? And what milestones will you achieve over the next 18 months such that a Series A investor will find you attractive to invest at that point? That's really the main thing. You really have to have a clear mission of like, okay, I need this money so that I can get to 200K in MRR by month 18. That's a pretty basic metric. So anyway, we're happy to turn it over to Q&A and answer anything. And after the session as well, via our website and phone calls, whatever.
Wonderful. Well, thank you, Jim and Mark, for an incredibly in-depth overview. Given the time that we had, just really amazingly informative and inspiring. And I know you probably just touched the tip of the iceberg here. There's so much more. With the Q&A, just as a quick reminder, if you have questions, please put those in the polls section of the conference platform. I put some information in the chat here. Really, you need to go to the agenda. You can minimize your screen and you'll be able to see that pop up. We're not going to be using the Zoom chat for the Q&A, so please do add your questions to the polls section, and I'll let Jim and Mark sort of guide us towards. We won't be, of course, able to get to everyone's questions, but we'll do our best in the time allotted. Thank you.
Okay, Mark, why don't you grab the first one, whichever one.
Jim, why don't you start? I'm having trouble seeing the.
Oh, okay. Actually, yeah. How do you expand the actual question? It looks like they're cut off. Okay, well, I can see this one. Okay, yeah, it looks like they're shortened, truncated. Hold on, let me expand my. Maybe you click on them.
Okay, let me see if I can help here.
It looks like we only see the beginning of a question.
Alrighty, let's see.
Sorry, everybody. All right, well, I see one that's complete. Maybe Eva, if you can get with the IT and see how we see the full question. Yep. But the first one I'll answer is, what is the role of IP in successful fundraising? Really depends on the product. I would say I touched on that a little bit. It's not absolutely essential, but to give you an example, two easy examples. QCI, or quantum computing company. If they didn't have proprietary IP after developing it at Yale for 25 years, there'd be an issue. You know, they're building sort of software and hardware for the first quantum computer and trying to basically build the next Intel. That's a very IP dependent portfolio. So that was sort of essential to them being able to raise money. And that's something we diligenced extensively. And in fact, the IP was licensed directly out of Yale. Again, don't panic. It was a Princeton undergrad founder who was the founder. And then another example is plenty of companies where, like a direct to consumer, like Paravel with Andre Rockefeller, who's the Princeton founder there. I mean, they have incredible amounts of skill in terms of sourcing completely sustainable materials to make and manufacture all of their products. But is there intellectual property around that? It's not as dependent upon that. So it really depends. Biotech would be something where clearly it's a little more important.
So I would just add that, you know, my view on a lot of times, if it's especially if it's a software company, that the intellectual property it's worth spending the money to file patents and to secure patents, not so much because you're going to keep out competitors in the future, because, you know, engaging in patent litigation can cost, you know, tens of millions of dollars to do that. But it's really good value creator on exit of the company, so that a lot of times big company acquirers will want to see that patent portfolio from the startup as a way to sort of check a box in their acquisition process and justify a higher valuation.
Hey, Mark, by the way, if you click on full screen results, that's how you see the full question.
All right.
I can do the next one if you want.
Yeah, if you don't mind.
Okay.
I'm not saying it at all for some reason.
Okay. How do you track performance of a startup? Okay, for us, we don't want board seats, even if we're the lead investor, and we've led several deals. Typically we're a co, but oftentimes we're also the sole. And there are different reasons for that, but what we do want is a board observer, right? So we track the performance of our companies primarily as a board observer, but to be honest, when you're an early stage investor like us, we're having calls with our company founders much more frequently than the cadence of a board meeting, schedule. And so really tracking it in quasi real time, you know, with calls on a weekly basis with our founder, not in any kind of like, we're going to have an update call on this date. It's more, you're continuously talking to them. As you get to be sort of a later stage investor, or if you're an angel investor, you're not going to have that opportunity, nor is it necessary. And so typically what you would like to at least get is what we call information rights, so that on a quarterly basis, you're getting the board deck that is circulated at the board meetings. But typically if you're an early investor, you negotiate that going in. So whatever makes you comfortable. Can you see them, Mark?
I can't see any questions for some reason.
Okay. Okay. Well, I'll start. You weigh in. Okay. Okay. Can you talk about phases of investment prior to when you would get involved, pre-seed, angel funding, et cetera? So that was really around the discussion on that one slide. I know we went quickly, but you know, friends and family, we would typically see get in first. Angel investing, whether it's through Princeton alumni angels or any other angel groups, potentially coming at it. We just wrote a term sheet for a company that came out of Techstars, you know, these accelerator programs. But we, as an early stage fund, we will go in alone. Like I said, at QCI, the quantum computing deal, we were the first investor in there. And the only other investors at the time were Yale professors. in optimal dynamics that came out of Princeton, we were the first institutional money, and we did co-invest with one other angel. So we'll get involved really early, but typically, for traditional seed stage venture investors, they would expect to see some angel funding, maybe an accelerator program, friends and family. Anything else on that, Mark?
No, I think you did a good job.
Okay. When is the best time to reach Fitz Gate? I like that. As soon as you want. One thing we always tell people is, like you're saying, looking for a pre-seed of 1.3. We would talk to a founder at the very earliest point that they are working on their company, because it may be too early for us to invest, and maybe it's not. But if it is too early, we do like to build relationships. You would think as a seed investor that we, meet a founder and we invest. I'd say if you look at our 17 portfolio companies, the average time we were engaged with a founder is anywhere from 6 to 12 plus months, right, Mark? I mean, we sort of track them. Oftentimes from that friends and family around, and stay in touch. And it's really helpful to us because we want to get to know the founders first and foremost over time. And then to see if we keep all the old decks, did they do what they said they were going to do? Are you at least tracking somewhat?
Jim, you're giving away our secret.
Yeah, I mean, so that's why, and even the Series A investors, they'll say, we want to meet you and socialize, at your seed round, even if we're not coming in the seed round, because especially now over Zoom, where we've made our first investment a few weeks ago, where we never met the founder other than by Zoom. And so, just the more touch points you have, the more comfort you get around founders.
Yeah, and we'd like to, even if we're not going to invest either at that stage or at all, we like to provide help to our fellow Princeton alums and professors who are starting companies. And so we always try to do that.
Okay. For informing, or I'll read this one, and Mark, you can answer. Let's say, for informing an investor about the use of the capital raised, how specific do you suggest we should be, i.e. plan to hire a sales team, enhance product? Is that enough? So they're basically asking, when you describe the use of proceeds to an investor, what kind of specificity do you need?
I mean, you can do whatever you want. I always think that the more specificity, the better, because in my mind, that shows that the founder is planning ahead and has been thoughtful about their plan and how they're going to use our money. Because ultimately, this is, I said our money, but it's really not our money. It's the money of our limited partners that we're investing on their behalf and to whom we owe a fiduciary duty. So we want to make sure the companies we're investing in are going to be good stewards of that money and not spend it willy-nilly. And so to the extent that you can present a plan for how you intend to use the money, I think it shows a good handle of your business and inspires confidence in the investors.
Yeah, it sort of speaks back to the whole capital efficiency. You can't be very capital efficient if you haven't really thought through every dime that you're going to spend. Okay.
So unfortunately, I think that was about the time we had for the last question. How about a quick round of words of advice, parting words of advice very quickly?
For us, I mean, we are open to speaking to anybody on this webinar, even if you're not a founder, and or if you're thinking of ideas or whatever. We just happy. That's part of our value add, is just connecting to the Princeton Network and seeing how we can be helpful, even when there may not be an investment opportunity for us. So feel free to reach out to us.
Right, and then for the founders on the call yourself, this sounds trite, but just keep going, keep trying, don't give up. We've seen so many companies that have been successful despite significant hurdles like COVID or other things, and you can be successful if you just continue trying. Yeah,
that's a great point. It sounds so ridiculous, but really, if you don't want to fail, don't quit. Okay, so that's it's like so simple.
And the perfect way to wrap up this session. Thank you both again for being such an inspiration to our graduate students and our alumni community, and really just rendering visible and expanding that Princeton entrepreneurial ecosystem. Thank you, thank you, thank you. And please visit fitzgate.com for more information, and gradfutures.princeton.edu for more information about graduate students and entrepreneurship. Thank you all for joining us today.
Thank you, Eva. Appreciate it.
Thank you. Thank
Bye.
you.